Ever wonder why someone would actually pay to get rid of oil instead of selling it? Let's find out. Welcome to the channel. Every day I explore personal finance questions that real people are asking on Stack Exchange and highlight the top answers from the community as well as any key takeaways. If you're new here, consider subscribing for daily videos just like this one. All right, let's take a look at today's question. Today we're exploring a common question. What does it mean when oil prices go negative? Here's the original question as it was posted to Stack Exchange. I'm going to scroll through it quickly so you can see the whole question, but feel free to pause the video if you want more time to read it. Don't worry. After this, I'll walk you through the key points of the question so you get the big picture. So, to sum it up, someone's scratching their head over a graph on the New York Times that shows West Texas intermediate oil priced at negative $13.10. They're curious if this really means someone is paying to have oil taken away. It seems like one of those bizarre market moments, maybe a trader trying to pass off a headache before something big happens. Here's the top-rated answer from the community on Stack Exchange. I'll scroll through it quickly so you can see the full answer. Feel free to pause the video if you want more time to read it. Don't worry, I'll highlight the key points of this answer in just a few moments. In this answer, it's explained that futures contracts expiring on April 21st oblige holders to accept 1,000 barrels of oil per contract. Negative oil prices happen when storage is full, pushing speculators to sell contracts urgently, resulting in negative prices due to the lack of buyers. Now, before we jump into the next part, if this video has been helpful so far, be sure to tap the like button and subscribe to the channel. We post new personal finance videos every day to help you make smarter money moves. Here's another answer that was shared in the Stack Exchange thread. Like before, I'm going to scroll through it quickly, so feel free to pause the video if you want to read it yourself. Otherwise, I'll highlight the main points of this answer in just a few seconds. In one response, it's noted that Russia and Saudi Arabia have been overproducing oil beyond OPEC limits. The pandemic has led to a drop in demand, causing a surplus, and negative oil prices happen when producers need storage to avoid shutting wells. Here's one last answer from original post on Stack Exchange. I'll quickly scroll through the answer so you can read it. Feel free to pause the video if you need more time. And just like before, I'll be highlighting the main points of this answer for you in just a few seconds. One response points out that negative oil prices happen because storage in Oklahoma was nearly full. Without storage, holding onto oil can cause financial trouble, so a negative price means paying others to take the excess oil away. All right, now that we've seen what the community had to say, here's our take on this question. Negative oil prices mean sellers are actually paying buyers to take oil because storage is full. It's cheaper than storing it. This scenario highlights how supply and demand work in commodity markets. When there's too much supply, prices can plummet. Plus, when storage is maxed out, holding on to oil can be more expensive than selling it at a loss. So in this video, we've covered how negative oil prices happen when sellers actually pay buyers to take oil off their hands because storage is full. When there's too much supply and not enough demand, prices can drop dramatically. With storage costs high and delivery constraints complicating things, selling at a negative price sometimes becomes the best option. Thanks for watching. Before you go, did you learn something new from this video? If so, be sure to drop a like on the video to let us know.